Hi you guys! I was not planning on making this video, but a lot of you requested it, so this is going to be personal finance. A few disclaimers before we start. First is that this topic, the information about it usually varies from semester to semester, so without having seen the lecture for it, I'm not entirely sure what will be covered this semester. This is going to be information that I think is most important and information that has usually been covered in previous semesters. So if there are discrepancies, I'll make sure to either make a follow-up video or invite you to ask me questions at a later date. At the very least, you will learn something important and valuable about personal finance from this. So with all that in mind, let's get started. The first topic I'm going to cover is credit, and credit is the ability of a customer to obtain goods or services before payment based on the trust that that payment will be made in the future. Your credit history is extremely important as it affects a number of things that you see below, such as your ability to get funding for a mortgage or consumer loan, and it also affects the interest rate that you pay. So if you have relatively poor credit, you'll have to pay a higher rate, which obviously is not favorable. Your credit history also affects your ability to rent an apartment because your landlord wants to make sure that you'll be paying them in full and on time every month. Your ability to buy or lease a car, open bank accounts, purchase insurance, or even get a job. So it's very, very important. Your credit score and credit report are what people look at when they're considering your credit as a whole. A credit score is a statistical figure used to determine a person's creditworthiness and probable ability to repay debt, and it ranges from 300 to 850, with 300 to 629 being relatively bad, 630 to 689 being fair, 690 to 719 being good, and 720 to 850 being excellent. So obviously you'd prefer to be over here. And then your credit report is a document that contains the information used to determine your credit score. A little more detail on that. Your credit report is the document that contains the most information about you, as it contains personal information, account information, bank information, and then other negative items. Personal information includes your name, date of birth, social security number, phone numbers, addresses, former employers, etc. Account information includes retail accounts, financial accounts, any mortgages, rentals, and other things like that. Bank information mainly covers your balance and payment history, and then negative items can include tax liens, court judgments, bankruptcies, etc. When analyzing your credit report, a lender wants to see a few things. First, they're analyzing how much you can afford to pay, and that is based on your current income, your employment, do you have like a steady job that we'll go over later, your current debt level, and they'll also look into your assets and liabilities right now and look at what liquidity you have and other collateral. So if you can't pay them, what can they take from you? They also look at will you repay the loan, and here we're considering things like bill payment history mainly, and then past loans you've paid, types of credit, etc. They're looking for stability in employment and housing, so do you hold a job steadily over time? Do you have housing? Do you pay for that housing? They look at consistency in paying bills on time and over a long period, and they're also looking for a relatively high credit score. Usually they'll have some sort of cutoff for approval. So, your credit score is based on 5 main things. The first is payment history, and that makes up 35%. Payment history concerns itself with do you pay in full and on time, and that's the most important thing. They want to see a long history of you paying all your bills completely and paying them ideally before they're due or by the time they're due. The second is amount owed, that's 30%. And basically they're looking at how much debt is outstanding currently. So what other liabilities do you have? What's your likelihood of paying them off? Stuff like that. Then they look at the length of your credit history. Obviously you want it to be longer so they can be more sure that you consistently pay your bills over time. and basically just more data for them to look at. They look at your credit mix, which is the types of credit used. So ideally you want to see a good mix, so different types of credit cards, different loans, maybe on a mortgage, stuff like that. And then also they look at new credit as the remaining 10%. So here you just really want to try not to open lots of new accounts at once. That might look a little bit suspicious. It might lead to inquiries. The three scoring agencies are Equifax, Experian, and TransUnion. Those are the biggest three, and the three you're most likely to use. How to improve your credit score. So this is really important because, as you said earlier, you want your credit score to be higher because then you pay a lower interest rate and you're more likely to be approved for new types of credit. So the main thing is pay bills in full and on time. That is the most important. They want to see a long history of you doing this. Next is keeping credit card balances low. You don't want to max out your credit cards. That's obviously not great, and it's better to have small balances on several cards. Next, apply for new credit cards only as needed, and don't close old ones because that just shortens your credit history. Keep them open even if you're not using them regularly, just to show more sources of credit. Along with that, diversification is important. So using a variety of credit sources from loans to mortgages to credit cards to show that you're capable of handling multiple types of credit. Paying off debt is important, and then correcting any errors you find. So if an error does occur, it's best that you spot it by checking your credit reports regularly and then get it fixed. And the other topic we're going to cover just quickly is budgeting. So a personal budget is a finance plan that allocates future personal income towards expenses, savings, and debt repayment, taking into consideration past spending practices and current personal debt. A budget is helpful because it helps you reach your financial goals, so you set a plan in advance, you're more likely to reach your goals. It helps you prioritize and control debt. It ensures you don't spend money you don't have, so you're living within your means. And then it helps you be prepared for emergencies and unplanned financial events. So if you have a budget and you have money allocated towards different things, you can have money allocated for emergencies and unplanned events. You're not spending too much at any given time, so you don't have money if something arises. And then the 3 steps to building a budget. The first is to calculate your monthly net income. So what income are you receiving from sources of employment minus any taxes you have to pay. Then you should estimate your monthly fixed and variable expenses. So what do you have to pay for rent? What do you have to pay for food? What do you spend on entertainment? And then 3 is calculate the difference and make adjustments. So how much are you earning? How much are you spending? How much do you have to save? You'll likely be spending the most on housing, food, and transportation, but then you might have other variable expenses. And basically, the most important thing with budgeting or any financial plan is that you go in and reevaluate it over time, adjust it as necessary, and just continue to keep monitoring it. So that's all I have for you for personal finance. Not a lot, but these are the most important things that I think. And obviously, if there's any follow-up questions, please feel free to message me. Hope you have a great rest of your day.